This week on Wealth Track, award-winning financial planner Harold Evensky is on a crusade to protect retirees' lifestyles, nest eggs, and portfolios through their golden years. Strategies for maintaining your retirement castle are next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Question: what is retirees' greatest fear? Answer: outliving their retirement savings. Well, in this week's Wealth Track, we're going to talk about a strategy to make your retirement portfolio last with one of the most respected financial planners in the country, Harold Evensky. Now, this topic could not be more timely or needed. Recently, we learned some distressing news about the state of retirement finances from the acknowledged experts in the field, the Employee Benefit Research Institute. EBRI, as it is called, has released its 23rd annual Retirement Confidence Survey, which gauges the views and attitudes of both working age and retired Americans. The survey's results have been worrisome for years, with confidence of both groups declining since the financial crisis. But even with the economy improving, the state of retirement planning and preparedness has not. The percentage of workers confident about having enough money for a comfortable retirement is essentially unchanged from the record lows of 2011. While 13% are very confident and 38% are somewhat confident, 28% are not at all confident and 21% are not too confident. Retirees themselves are more optimistic than workers, but less so than they were pre-financial crisis. 18% of retirees are very confident that they will have a financially secure retirement, and 44% are somewhat confident, while 14% are not at all confident and 22% are not too confident. And debt levels are perceived as a big obstacle to achieving financial security in retirement. 55% of workers and 39% of retirees report having a problem with their level of debt. And one of EBRI's most shocking findings was the lack of even a short-term financial cushion for many. Only 50% of workers and 52% of retirees say they could definitely come up with $2,000 if an unexpected need arose within the next month. Well, if planning is key to a secure retirement, the future looks bleak. Just 23% of workers and 28% of retirees report they have obtained investment advice from a professional financial advisor. Well, they are clearly not viewers of Wealth Track. We are consulting one of the best in the business this week. He is Harold Evensky, president of the fee-only financial advisory firm Evensky & Katz. He has been recognized as a top financial advisor by numerous publications, and he was awarded the Dow Jones Investment Advisor Portfolio Management Award for Lifetime Achievement, and is the author of several books, including Wealth Management. He is also known for having some unusual approaches to retirement planning, and one is to have his clients assume they will live until 95. I asked him why.
Because people tend to focus on the probability. It's, well, I'm not going to live that long. We remind them the consequences of being wrong. Even if there's only a small chance of living that long, the risk of dying early means you leave some money on the table. Well, that may be sad, but it's a whole lot worse to live beyond that and not have any money left. So that's why just the consequences are catastrophic if you don't plan for it.
Harold, one of the other expectations that you have your clients depend upon in their retirement planning is to expect, number one, high inflation and also a significant market downturn. And here we are in a low inflation environment. And yes, we've had a significant market downturn, but guess what? The market's more than doubled since the lows of 2009. Right. So why those assumptions?
Because we're talking 20 or 30 years. They're likely to see a whole bunch of market cycles up and down. So we want to refocus our clients from the short term, gee, interest rates are low today, what are we going to do? We're planning for the rest of their life. So unless they're prepared for volatility, good years and bad years, they're not going to make it long term.
Some other reality checks, and again, you really have a different approach than most of the financial planners that are out there. One of them is that just about everyone in the financial planning industry basically has historical assumptions about future stock market returns. So 10% plus annualized returns in the stock market, and let's say 5% annualized returns in the bond market. You have ratcheted those expectations down considerably. Why?
We think the only planning that makes sense is forward-looking planning. It doesn't mean we ignore history, but we need to plan about what the future is going to be. And based on our best guesses and assumptions, we believe that returns are going to be relatively modest historically. So for the stock market, our current assumptions for planning is about 8.5% with a 3% inflation, and the bond market about just a little under 5, about 4.75.
And so those are nominal returns.
Those are nominal. So take 3% inflation. Our inflation assumption long term is 3%.
Right.
And so it means that there's
very conservative.
We think it's very realistic. We're not trying to be conservative, because if you're conservative, then you leave money on the table. So the best we can do is try and make the most reasonable assumptions. And the other criticism I certainly hear is this buy and hold is out. It's not buy and forget, it's buy and manage. So 5 years from now, those assumptions may change again. They're not going to change on a weekly or yearly basis, but we're always constantly looking forward and trying to make the best guesses we can, and at least on an annual basis, revisiting those.
So with reduced expectations for returns from both your bond and your stock portfolio, things like expenses and taxes become very, very important in the kind of returns that you're going to get, right?
I lived most of my career in the good old days. We were making so much, percent here or there, who cares? But if you believe anywhere near those kinds of numbers and you figure out what's left, it's not very much. So we have no control over returns. We have some control over expenses and taxes. So if we can save 0.5%, that's a huge increase. So bottom line, I absolutely agree. Real focus on managing taxes and expenses. It's the one thing an investor has control over.
So let's talk about how you do that then. So tell us, what strategies you're employing to really minimize the impact that taxes have, for instance, and expenses have on your portfolio returns.
When we first faced this decision, is my goodness, nothing's changed in our philosophy. We believe in diversifying, domestic, international. So fairly quickly, I came across an institutional strategy called core and satellite in stocks. It means the bulk of our investments are simply in the market. We're not trying to beat it. So we use primarily ETFs, exchange-traded funds, very tax efficient, very low cost, and that's about 80% of our portfolio. Instead of taking a little piece of risk throughout, we concentrated on what we call the satellite. There, we can take a lot more risk. They can be expensive, but we think those managers will overcome that drag. But it's only a small portion of the portfolio.
So 80% of a total portfolio is in this, what you call the core, are passive investments, is that right?
80% of the equity.
Of the equity,
yes.
Okay, portfolio
Correct.
is
in passive.
In
correct.
passive. And then the 20% of the equity is in the actively managed funds,
It can
for
be
instance.
anything. We split that into a lot of little pieces. We're afraid to make any major bets. So it could be, there was a period after the recovery from the tech bust, and we have a value bias, and value came roaring back, so growth didn't look so good, so we used the S&P 500 growth in the satellite. So we've used junk bonds in there, commodities. So it could be most anything. We had a position shorting 30-year treasuries for a while. So anything goes.
And what difference does that 20% make in the returns of the portfolio? What do you expect from that 20%?
The target is 2% over the broad market returns.
On an annualized basis?
On an annualized basis, yeah.
And how do you decide, for instance, right now, what of course we're more interested in the satellite portfolio, at least I am, because that's you're actually choosing what specific managers you want to go to or what specific styles. So right now, what's your satellite
we have
portfolio look
an
like?
Emerging market position in there. We have a high yield bond. We have a large cap, sort of a super large cap value oriented But again, it changes all the time. One of the ways in which we decide what to do is we start looking at, okay, what has done terrible for the last few years that we think is a fundamentally sound investment? And that's going to get us interested. Someone comes in to us and says, wow, we were at the top last year, don't even want to talk to them. We want someone to come in and say, boy, it was a disastrous year, our particular style or strategy is out of favor. That's what I'm interested in.
So what about the bond portfolio? How do you handle fixed income?
Okay, fixed income, we're in to preserve principal. We have, in a normal environment, we want an interest rate exposure measured by what's called duration, about 5 years, and quality A or better. We've been very defensive for quite a few years, AA in like 3.5 years. In hindsight, we were too defensive.
Right, because the high yield, the junk bonds did really well.
And interest rates went down, so we could have been longer term and done really well. But we've done a couple of things. We have maintained our relatively short exposure in interest rates, because if rates go up, we don't want to get killed. But we trust the Fed a fair amount, that it won't go up overnight. We think the short end may go up faster than the intermediate, so we've, instead of sort of equally throughout, we've reduced a little bit that 1 to 3 years and increased a little more the 2 to 5 year. Somewhat contrary to our normal approach, because we tend to be plain vanilla, we've added 2 what are called unconstrained managers. These are managers who go anywhere, do anything.
It's strictly in fixed income?
In fixed income. They can lower the quality, increase the quality, go emerging markets. The reason that we did it and got interested, one, we've worked with both firms and respect them, but they've using that flexibility not to try and make more money, but to try and weed through what is clearly a sort of a scary fixed income market. And they've done a pretty good job so far. So that's the other sort of tweak that we've done.
So one of the things that you told me earlier was that an income portfolio, kind of as a goal, is really dangerous.
Yes, that drives me up a wall, yes.
And you know that is probably one of the most popular strategies now, because people in a yield-starved world are looking for income, and so that's what they're all focusing on. Why does it concern you so much?
It concerns me. It's an easy sale, and it's a story that sounds credible.
Right.
But I say, people don't need income. They need real cash flow. If you do an income portfolio, presumably that's based on dividends and interest. Mm-hmm. Your allocation, how much in bonds and stocks, is completely driven by whatever interest rates and dividend rates have to be. So today, it's going to largely be a fixed income portfolio, fairly extended maturities.
Right.
Which we don't think makes much sense for anybody. Beyond that, okay, you have an income portfolio and interest rates go up. Now you feel rich, you're getting more money. The fact of the matter, your portfolio value went down. Interest rates go down, you're feeling poor. What's happened? Your portfolio is worth more. So it's counterintuitive. And finally, the income goes up or down. There's nothing consistent about it, and it's not real return. It typically is, if it's bonds, it's a nominal return. So other than that, it's perfect.
So for individuals, your clients who say, look, I want income, and you've got to generate income with my portfolio. So,
right,
so
which is common.
Yeah, so what do you do
we
for
design
them?
what we call a total return portfolio, so that we're looking at the portfolio, trying to design it cost and tax efficiently. For the cash flow needs they have, we carve out, literally, someone has $1 million, they need $50,000. Say, okay, we're going to invest $950. $50 we're going to put in a money market fund. Set it up to pay you a check every month, like a payroll check. Mm-hmm. We're going to manage this portfolio. When stocks go down and bonds are up, we're going to sell bonds, buy stocks. Oh, gee, let's fill it back up. So we control when to sell something. We're not forced to sell at the wrong time. We're not selling little pieces throughout the portfolio, sort of a reverse dollar cost averaging. So it allows us to be very cost and tax efficient in the portfolio. From a behavioral standpoint, it's immensely powerful. We've started doing this back in the early 80s. We were doing it before the 87 crash. So no one was happy, but our clients didn't have to worry where their grocery money was coming from. They knew where it was coming from. Tech bust, no one was happy, but no one had to sell. They were able to stay in, kind of ignore it until the world went back up. Same thing with the Grand Recession. It's our basic belief is over time, domestic and world economy will go up, stocks learn more than bonds. That is the basic belief, but you have to have time.
Right, so how much time do you have to have that work?
I would have said 5 years until a little while ago. Now probably 10 years. I mean, but the fact of the matter is it hadn't been 5, and balanced portfolios have recovered. So
right.
roughly an economic cycle. But again, having 1 year and constantly filled up, we've never hit a point that that's been a problem.
So one of the things that you also, told me, again, contrary to, common wisdom, is that a lot of investors have become very risk averse, and therefore that they have, basically either gotten out of stocks completely or reduced their stock holdings dramatically. And you told me that they're not actually being risk averse, they're being loss averse, and there is a big difference. So explain the difference.
We hear all the time that investors are risk averse. The fact of the matter is people don't want to take a risk to get rich, but they will take a risk not to get poor. I mean, the way we explain it, if very conservative client comes in to me and I say, look, if you go to my buddy upstairs, a broker, and they're going to see your portfolio, I say, we got to make you some money. We got to put some in the market. You're going to say, I'm out of here. We may go through this whole planning process and say, unless we put about a 50-50 portfolio, you're not going to be able to maintain your standard of living. So I've literally had very conservative clients say, wow, that makes sense to me. I understand why I have to do something that will make me uncomfortable. Because if I don't, the fact of the matter is it's a bigger risk for not doing it.
Right. So is there any such thing as a safe investment these days?
No. Never has been.
Never has been?
Relatively
US
safe
Treasury
portfolio.
Securities at one point, weren't they?
Okay, no. I mean,
you got your money back, but...
Got your money back, but with inflation, it may not buy anything.
Right.
So every investment is going to be subject to a couple of risks, either to the market risk. You can buy the 500 blue chips, S&P goes down, you're in trouble. So I'm going to be very conservative. I'm going to put it in bonds, 10-year treasuries or munis, AAA. Interest rates go up, you're in deep trouble. So, okay, now I'm going to put it in 1-year CDs and roll it over every year, which I had clients that did it. They were getting 15%, the next year they got 10, the next year they got 5. They came in tears. Harold, I'm got a third of the income. Yeah, right. You still got all your principal. Wasn't that safe? Well, of course it wasn't safe. And then finally, purchasing power, inflation. You can have every penny you started with and you can't buy a hamburger. That's not very safe. So the answer is you need a safe in quotes, but a safe portfolio. There's no such thing as a safe investment.
Right. So explain your bond strategy, because I know that you said that you have laddered portfolios in bonds, and when we talked about having a core strategy in passive funds, ETFs and whatnot, in equities, you don't think that works so well in the fixed income world?
We're still trying to get our hands around sort of the fixed income ETFs.
Right.
Our belief is the bond market is much more inefficient than the stock market. So we see potential advantages in active management in bonds. In a general universe, we'd have real simple, maybe 3 positions, something in a short-term bond fund, Vanguard short-term, and something that we call short intermediate, like 3 to 5 years, and something in intermediate, put a third, and a third. That would be what we would call the core. What we have in addition to that is we have an allocation to tips.
Still, even though the negative yields?
Even though it's not huge, but we don't know tomorrow what's going to happen. So the only way to protect is to be there. And then we have these 2 unconstrained. So it's gotten a little more complicated, but as a function of what's going on.
Looking at what's going on, and we have the Fed doing unprecedented things. As you know, we've got worldwide easing. There are so many factors that certainly affect the market on a day-to-day basis. Is there something that you're doing differently that you wouldn't have done, let's say, 5 or 10 years ago?
Certainly would not have added 2 unconstrained managers. That makes me nervous. I mean, it's not consistent.
Because you don't have control over it?
Because when you give managers that much flexibility, they can do a great job or they can make some major mistakes. So we're just, again, we tend to be particularly plain vanilla in fixed income. We've added in our portfolio what we call an alternative category. We're certainly familiar with the alternative, the hedge fund universe and private equity, but we've historically stayed out of it because what's available, what I consider the retail market, which I define about under $100 million, is, my apologies to perhaps some of the listeners, I consider it opaque, expensive, and third rate. It's just not institutional quality.
Right.
So we've stayed out of it. What happened after the Grand Recession is there were managers who we respect who came in with sort of mutual fund type alternative product.
Right.
That we
well,
thought.
Cliff Asness, Andy Lowe.
Those are two that we use.
Right.
And so said, okay, because they're unleveraged, the returns aren't going to be that extraordinary. We think they'll be between bonds and stocks. So we took 3% from bonds and 3% from stocks and said, let's put it in these alternatives. We think they're poorly correlated with the market, so it'll provide some buffer. Because it's half and half, it shouldn't affect our returns. And so that was a major change for us.
And what about annuities?
Many years ago, I was quoted famously saying I'd wash my mouth out with soap before I talked about immediate annuities. I think it's going to be probably the single most important investment for the next decade and longer. Not yet, but...
And why not yet?
Because what they pay is pretty totally dependent on what current interest rate environment is.
Right,
and it's so
low. Forget it now.
Right. The risk of waiting, and it really doesn't make sense until someone's maybe 70 or older.
To buy an annuity,
to buy it.
a fixed immediate annuity.
Right. The advantage of it is the mortality return. You can get a return. Any other investment is going to be dividends, interest, or capital gains. An annuity has another component, mortality return, which sounds good. It means if you die early, you had a lousy investment, but you're dead, so you don't care. If you live longer, you're getting some of the money that whoever died early left on the table. If someone's 70 today and we don't do it, we wait a couple of years. Well, the likelihood mortality is going to change dramatically is slim. If interest rates regress back to a historic norm, the payments will be much more attractive, and 2 more years, the mortality returns go up pretty substantially. So I say we think it's going to be a really important vehicle.
So at what level of interest rates do you start seriously considering annuities?
I'd say when they come back to historical norm. In other words,
5%?
Somewhere in that range.
Right,
probably,
for a 10-year,
right.
for instance, something like that.
Exactly.
So another interesting approach that you have is that your intention for most of your clients, unless they express otherwise, is to spend their portfolio down. You want them to basically die penniless. So
the joke is, the last check they write bounces. That's the perfect planning. Okay, so it's not that we don't want them to leave money. If their goal is to leave, I'd like to leave my kids $1 million and my college, that's great. We'll build that in the plan.
Right.
But unless they tell us that, we're not looking for them to die with a big chunk of money, because it means they either had to invest more aggressively, or they had to reduce their current standard of living. People talk about being conservative and forget there's always a flip side. Well, I don't want to consider Social Security. Okay, let's not consider it, but then to do what you want to do, you're going to have to invest in leveraged pork bellies, or you're going to have to cut your spending by 20%. So conservative is a nice word, but it really doesn't have a lot of meaning. So best we can do is try and make the most reasonable assumptions we can.
One investment for a long-term diversified portfolio, what would you have all of us own some of?
For long-term, certainly S&P 500, Russell 3000 is a minimum. The next we would expand it to some small cap and value allocation, certainly international, that's more than half the world economy. And last, I would say emerging markets.
Harold Evensky, thank you so much, award-winning wealth manager. Thank you so much for joining us on Wealth Track.
Thank you so much for inviting me. I enjoyed it.
At the conclusion of every Wealth Track, we give you one suggestion to help you build and protect your wealth over the long term. This week's action point picks up on Harold Evensky's comment that immediate annuities are going to be, quote, probably the single most important investment for the next decade and longer. However, Evensky's view right now is that with interest rates so low, the returns these annuities offer are not that attractive. And most financial advisors agree with him, even though the payouts are still much higher than what you get on long-term U.S. Treasuries, for instance. So this week's action point is familiarize yourself with immediate annuities. When interest rates do rise, which they are bound to do sooner or later, you will be prepared to act. A second annuity strategy was brought to my attention by Mary Beth Franklin, longtime personal finance columnist at Kiplinger's, who is now a contributing editor at Investment News. Franklin advises looking into what are called deferred income annuities, which she says are a great way to lock in higher returns now to begin at a date in the future when you will need the income. They are especially good for pre-retirees. Payouts can be 10% or more in 10 years. Now, you still pay a lump sum to an insurance company now, but you determine the date your monthly payments begin in future years. Some also allow you to add to the investments and change the date the payments start. Franklin recommends looking into New York Life's Guaranteed Future Income Annuity because they pioneered the product, have been in business since 1845, and have the highest credit ratings of any life insurer. New York Life is a sponsor of WealthTrack, but that does not affect the opinions of Franklin or any of our other guests. Well, next week, we are going to have a television exclusive with a mutual fund manager who is considered to be one of the top stock pickers of all time. CGM Focus Fund's Ken Huebner will join us to discuss his bold, contrarian strategy and extreme performance. In the meantime, thank you so much for taking the time to visit with us. Have a great week and make it a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.